How does the tax code screw up healthcare? How does public debt threaten public safety? And are Europeans poor? I'm Dominic Pino, Thomas L. Rhodes Journalism Fellow with the National Review Institute, and we'll look through those questions on this episode of Econception. Econception is a podcast of the American Institute for Economic Research that looks at the economic issues of the day and the broader economic concepts behind them. We're using the Econception time machine and recording today on location from the headquarters of the Office of Price Administration in 1942. One feature of the U.S. tax treatment of health insurance started right here with the wage and price controls of World War II. Healthcare and health insurance seems like a perpetual mess in public policy. Comes up often in election campaigns, but it seems like the solutions either don't help or make the problem worse. One person with some ideas on how to actually make it better is Theo Merkel. Theo is the director of the Private Health Reform Initiative at the Paragon Health Institute. He's also a senior fellow at the Manhattan Institute, and he's worked on healthcare policy both in the White House as a staffer and in Congress as well. And he's the author of a new paper, co-authored with Brian Blace, called Follow the Money, How Tax Policy Shapes Healthcare. So we're going to talk about how the tax code affects healthcare, and that's something that people probably don't think about a lot, Theo, is healthcare and health insurance as a tax issue. So why is it that you and Brian chose to frame this paper through tax policy to get at health insurance?
Thanks for having me, Dominic, and thanks for the question. So, as you know, we spend an awful lot of money in healthcare. A lot of it is through government programs, so that's what people tend to gravitate to. They think of we're spending almost $1 trillion in Medicare. We're spending $800 billion in Medicaid. But it's also worth noting that policymakers for a long time have both discouraged certain activities through the tax code. Smoking is probably the easiest example with an excise tax on smoking, but they also encourage other activities like home buying, saving for retirement, and healthcare, notably, by reducing the amount that these are taxed relative to other places that you can spend your money. Now, when you exempt something from taxation, you get more of it. And if you don't increase supply despite the increase in demand, prices go up. Now, that happens a lot in healthcare, but there's also another factor which is really explored by this paper, which is the design of these tax preferences. And that is that we favor certain types of purchases in healthcare relative to others. Notably, we heavily incentivize health insurance being purchased through your employer, or for low-income individuals, we heavily incentivize a purchase of specific types of insurance plans through the Affordable Care Act, which created the premium tax credit. And because we so incentivize these things, we discourage relatively purchase of healthcare yourself as an individual.
And so one of the things that a lot of people might know about healthcare in the United States is that in the U.S., we spend way more per person than in lots of other developed countries on health care. And we don't necessarily get results that are any better. And in some cases, we get results that are worse than other countries. And one of the reasons for that, as you point out, is that a lot of it is tax advantage. A lot of our tax code is designed to encourage people to spend more money on healthcare, and so people respond to incentives. One of the frustrating things about that, though, is that when someone changes jobs, they will not have to change their car insurance. They won't have to change their home insurance, but for some reason they do have to change their health insurance. Why is it? What is it about the tax code that makes that inconvenience and a lot of times actually a pretty significant problem for people when they're looking for work or changing jobs.
Yes. So what you are referring to, which is featured quite a bit in the paper, and it is because it is featured quite a bit in the tax code, is the exclusion of taxation on income that's devoted to employer-sponsored insurance. So this dates back to pretty much the beginning of the income tax system. You know, in World War II, during World War II, there is a massive increase in the amount of people that are hit by the income tax. There are wage and price controls, which fringe benefits such as health insurance are excluded from. And basically, this helps enshrine employer-sponsored health insurance as a feature of the American healthcare system. There's a lot of reasons why health insurance, especially privately purchased health insurance, has been a good thing relative to government programs. So I am not somebody that believes that there are no positive features to the fact that so many people are getting health insurance through their employer. But you do point to one downside, which is when you switch jobs, you have to find new health insurance. And actually, something that was spearheaded by my co-author, Brian Blaze, during the Trump administration, tried to marry some of the benefits of getting health insurance to your employer, which is taking advantage of this exclusion, with portability through the creation of what we call the individual coverage health reimbursement arrangement, which is basically allowing employers to provide the option for their employee to get a set amount of money that they could then go purchase health insurance out in the individual market. Therefore, if they were to switch jobs and either be self-employed, they could purchase it through the individual market, or if they were to switch to another employer that offered individual coverage HRAs, they would be able to maintain that same insurance plan.
And so when we talk about tax policy, tax deduction sounds like a good thing. People like tax deductions. Those are fun. But people don't really like to talk about tax policy as being regressive, which would mean it would either hurt relatively poor people more than it does rich people, or, the inverse of that, benefit rich people more than it benefits poor people. You guys talk about in the paper how the tax deduction for or the tax exclusion, I should say, for employer-provided health insurance is regressive. How is that? How does that work out? Why is it regressive? And should we overall think of it as a good or a bad thing?
Yeah. So great question. The reason that a tax deduction like the exclusion for employer-sponsored insurance is regressive is because the tax code itself is so progressive. So as you make more income, you fall into a higher income bracket. That higher income is getting taxed at a higher rate. That means if you are excluding something from taxation, the people that are at that higher rate are going to benefit from that exclusion more than somebody that is being taxed at a lower rate. We have a very simple chart to try to illustrate this in the report, where basically it shows that, if you are a couple that is making $80,000 a year and you have the average health plan, which is roughly $24,000, because of the exclusion, you get savings of roughly $6,000. Whereas take a family that's making $1 million, their marginal tax rate is all the way up at 40%. Therefore, the exclusion is a lot more valuable to them. They are saving closer to $9,500 on that health plan due to the exclusion. And basically, what this does is it creates an incentive that as you make more and more money, to want to devote more and more of that money to healthcare. I think our overall point in the paper is not that the exclusion does not provide value and doesn't make private health insurance more affordable for a lot of folks, but it does have diminishing returns at the top end.
One other popular health policy recently that has become that has grown is health savings accounts. So this is another tax advantaged way to spend on healthcare, because money that you put in there is not taxed, and then you're allowed to spend that on health related expenditures. These are limited to certain kinds of insurance plans, so mostly for high deductible plans. But what you guys point out in the paper is actually that this form of tax advantaged health spending is actually correlated with lower health spending than with higher health spending. So why is it in this case that the tax advantage doesn't encourage more spending like it does for the employer provided exclusion?
Sure. The short answer is it's relative to the employer exclusion, right? So there is, you do receive a tax break through the health savings account, but the amount is limited and it needs to be paired with a plan that is less generous. So it forces individuals to take the time to make value assessments on whether this care is worth it now, or whether another great thing about the health savings account is you can save that money for later, whereas with an insurance plan that has very generous coverage, you have an incentive to get as much from it at that moment in time because you've basically already paid your premiums, and therefore you want to get as much from the insurance plan as you can before the end of the year. This is a concept known as moral hazard. And, this is health savings accounts emerged as like this carefully designed policy by it was originally thought up by some wonks in the Nixon administration. And basically what they were looking at is they looked at sort of the ad hoc way that we were advantaging health insurance through the tax code and the ESI exclusion. And they saw several downsides from that. They saw that there was this incentive, this moral hazard issue where as soon as you pay, you have an incentive to want to consume as much as possible. However, you then change distinctly the value assessment that the individual is making on whether that care has high value versus low value. And a way that they wanted to change these dynamics was to give the individual more control over their dollars. Therefore, they have an incentive to make that decision on whether they think that this care, frankly, is priced in a way that is commensurate with the amount of benefit that they're going to receive from it. It's always a delicate balance, right? Like health savings accounts, there is some role for insurance regardless, given the unexpected nature of health insurance spending and how certain healthcare spending can be, it's what we call catastrophic, like a hospital visit. But the things that we want to do is basically incentivize more people to be engaging in cost-conscious decisions when they have the opportunity to.
And one of the federal programs that is sort of doing the opposite of that in terms of keeping costs under control is Obamacare. You guys point out in the paper that the Affordable Care Act is proving to cost way more than anybody thought it would when the program was enacted during Obama's presidency. Why is it that the costs are so much higher than people expected?
Yeah, so this is as many things in healthcare, this is a complicated answer to a simple question. So there are many different aspects of Obamacare. One thing is many of the pay-fors, basically, it was sold as something that was quote unquote budget neutral or at least close to it. But many of the pay-fors were gimmicks or have since been repealed. So when you actually look at the ledger sheet on how much money we're spending on Obamacare versus how much that original CBO score put out, it's going to be much more expensive. Another factor is the Medicaid side, despite the fact that not all states have expanded Medicaid, as was thought by CBO at the time. The states that have expanded Medicaid, it's cost a lot more than the CBO anticipated. We could have another entire program on why that is. And then the last component is this premium tax credit. And the premium tax credit, in some states and in some regions where there is significant competition, because the premium tax credit is tied to the value of an insurance plan, when you have insurance companies competing to provide that service, it's been okay at keeping costs down relative to what they anticipated. In other regions where there is less competition, insurance companies can almost dictate the amount of money that they are getting from the federal government through this premium tax credit. And then another element on top of this is states still have some level of regulatory authority over their individual markets, and they have come up with different ways to increase the amount of spending through the premium tax credit that's not necessarily purely associated with the high and efficient value for the federal taxpayer. So there's a lot of factors going on, and hopefully this paper helps unpack that for readers.
One of the other things that you guys unpack is just the history of how we got to this point. You guys go back all the way to the Truman administration and sort of go blow by blow in terms of a lot of the different changes to the tax code that have been made about healthcare. Because what happens a lot of the time is there's some changes made, and then it doesn't work out exactly like we think. So we make a new program to solve that problem, and then that causes other problems, and we make another one to solve that problem, and it just keeps layering on and layering on. And that's really where we are right now. We've sort of have this huge overlapping mess of incentives in the tax code that end up leading to a situation that we have, which is where we spend tons and tons of money on healthcare and don't really get the results that we should be for the amount of money we're putting in. I think for most people, regardless where they come from politically, they should be able to look at this and say, okay, this doesn't make very much sense. We should change this. But we just sort of keep making little Band-Aid fixes and sort of slapping a piece of duct tape on the side and just keeping it going. What is it about this system that has proved to be so durable? Why is it that it's so hard to actually make reforms to make the incentives line up and make sense and get better outcomes for Americans?
Yeah, this is something that's obviously broader than the tax code, but as I describe it in the paper, you have different policies that emerge from different types of circumstances. Some are carefully crafted policies that are meant to align incentives to ensure that people are getting higher value care and we are spending taxpayer dollars in an efficient way. And I would put HSAs sort of as an example of that. In other scenarios, you have political coalition comes together and strikes while the iron is hot without necessarily the appropriate feedback that you would like to see. And then they create basically a whole range of special interests that are highly invested in preserving that benefit as it is used, and the benefits go to a smaller group of people in a more intense way than the negative side, which is distributed very broadly across all taxpayers. So it does become exceptionally hard to change these policies given the amount of money that is in play. And then you often see this additive layer, which you have demonstrated, which instead of assessing the program that we have and whether we can improve it, instead we add another benefit of a different type. Sometimes those benefits are carefully crafted like an HSA. Sometimes those benefits are more ad hoc and probably make the program make the overall system more complicated without the commensurate benefit.
So a common criticism of free market types like you and me is that we're really good at pointing out problems in healthcare, but we don't have any solutions, and we're just sitting here being critics, and we don't have anything to offer to actually make it better. You guys in the paper, you do have suggestions on what we should do about this from a free market perspective. So what are those? How can we improve the tax code to get better outcomes for healthcare?
Yeah, thanks. I think that, it is much easier to point out flaws than it is to come up with solutions. And it's even harder, as any observer of Washington appreciates, to come up with solutions that are politically viable. Brian, my co-author, and I have spent both time as staffers in Congress and staffers at the National Economic Council during the Trump administration. So we tried to put on our thinking caps and provide recommendations on basically how can we incrementally move into the right direction, because you could design a better healthcare system. Many people could design a better healthcare system than we have today. But the key question is, how do you transition to that? Many people will probably note that this paper does not propose repealing Obamacare and the premium tax credit. Over many, many years, we have seen both Republican administrations and Democratic administrations propose various versions of premium tax credits or tax credits generally to help low-income individuals that do not get health insurance through their employer. So what we propose is trying to improve what we have. One of the things that was done very in the past few years was a large expansion of the premium tax credit in the American Rescue Plan, and then it was extended through the Inflation Reduction Act. These were things that were done on party lines, and what they changed about the premium tax credit was they both expanded how many people were eligible for it. So it used to be people were only eligible up to 400% of the poverty line. Now there's no income limit on the premium tax credit. And then the other really substantial thing that they did was they made certain plans basically fully subsidized. So they're free to the enrollee, but they are fully borne. The cost is fully borne by the taxpayer. We took a long look at the various versions of the premium tax credit that were proposed over time, and even the authors of the ACA at no point thought it would be a good idea to be fully subsidizing private health insurance for a large segment of the population. This has unsurprisingly grown. The amount of people that are enrolled in the ACA has grown in recent years, and more of them, over 50% in the federal exchange, are people that are no longer paying anything for their health, for a benchmark plan. We think that's one of the key things that Congress needs to reevaluate in 2025. We do not suggest continuing it, and we suggest going back to the same amount of percentage of income that the original authors of the ACA suggested. We also suggest capping the benchmark that's used to calculate the premium subsidy in Obamacare at 125% of the national average. Basically, we want to create some flexibility for regional variation in the cost of healthcare, but we don't want these scenarios where in areas with very low competition among insurance companies can inflate, basically get to choose or have a large influence on how much of a subsidy that they're getting. That doesn't at all correspond with the overall cost in the region. We do think that the employer exclusion, that, as I noted, there are diminishing returns. The defects of the employer exclusion look a lot less bad when you compare it to things like the premium tax credit or some of the design of our public programs. So we would not prioritize taking on the employer exclusion unless we were making substantial reforms to either the public programs or doing a fundamental tax reform where any revenue that was gained through the exclusion was passed back through to taxpayers through a lowering of the marginal rates. We make that pretty clear. But in an optimal world, that would happen, and we would cap the exclusion, again, at 125% of the national average to allow for some regional variation, as well as we would adjust it for the age of the employer workforce, as that is a key contributor to the cost that any single employer is going to be charged by a health insurance plan. For some of the more fun things, we do propose expanding eligibility for health savings accounts. Right now, they're tied to a pretty strict limit in what the deductible is going to be. This encourages individuals to have some skin in the game so that they are have a reason to be shopping around for high value care. We think that's a little too inflexible. We think that insurance design has evolved over time, so we would change that to a actuarial value threshold, which basically allows insurance companies to incentivize more high value care and in more efficient settings without losing that HSA eligibility if they were to do that pre-deductible. I spoke a little bit about individual coverage HRAs. The individual coverage HRA has not taken off to the extent that we had hoped. Brian and I discussed the reasons why in the paper. One of the main reasons is that the individual market plan offerings have been less than expected when it comes to the generosity of plans or the broadness of the networks. So one of the things that we can do is improve the individual market, but we also think that giving an employee the option to either choose their traditional employer-sponsored insurance or to enroll in an HRA if they want to could increase the popularity for these plans, because right now, with certain exceptions, it's a all or nothing approach for an employer. So we're big supporters of empowering both employers, empowering individuals with choice. I think that one of the clear distinctions between what those on the right side of the ideological spectrum and those on the left side of the ideological spectrum, sort of a trust in consumers and patients, and the benefits from enabling them with more choice and the ability to use their own resources, whereas the other side would generally, and their policies have been to mandate coverage in a specific way, and then ultimately it's either the insurers or the government that gets to determine what the value of your service are, or if you should get the service at all.
So there we have it, a list of concrete ideas on how we can use free market reforms in the healthcare space, especially as it relates to tax policy and how we treat taxation of healthcare, and a pretty good summary there, I think, of one of the differences between the two sides of this debate. Should the government be in the position of deciding what counts as healthcare, deciding what counts as deciding what should be covered, what everyone should be required to purchase? Is that how we ensure people get the coverage they need, or should the government be more in a position of enabling choice and allowing consumers as patients of healthcare to be able to choose what coverage they need, and then employers having that ability as well with our sort of employer sanction system that we have. And so Theo's paper, Follow the Money, How Tax Policy Shapes Healthcare, from Paragon Health Institute. Definitely worth your time to check that out. And thanks so much, Theo, for talking to us about it.
Thanks for having me.
Now I'm going to do something that's near and dear to my heart, and that is poke a little fun at the city of Chicago. I'm from Wisconsin. I'm a Packers fan, a Brewers fan, and so that means I'm not a fan of Chicago. But sporting rivalries aside, political observers in Wisconsin and in Indiana and Iowa and any of the other states that border Illinois are always astounded by the state's unbelievably bad finances. And a lot of those problems stem from the city of Chicago, Illinois' largest city by far, and despite not being the capital, still being the political center of Illinois. Judge Glock of the Manhattan Institute wrote a really good piece for City Journal where he describes the debt problem that the city of Chicago is facing. First, he just lays out the plain numbers. The debt load of the city of Chicago is about $40 billion, which is about $43,000 per taxpayer. On that per taxpayer measure, it's second only to New York City. But then on top of that, the state of Illinois has another $42,000 per taxpayer in debt. So that means a family moving to Chicago inherits about $85,000 in liabilities. That makes it the worst in the country. It passes New York City. Now, Glock says maybe this wouldn't be so bad because Chicago could raise more revenue to counteract it. But that's a really hard sell because Chicago already has really, really high taxes. Chicago's combined city and state taxes would eat up about 12% of the U.S. median family income, he writes. Chicago already has the highest sales tax of any major city at 10.25%, and it has extremely high property taxes and extremely high business taxes. Now, maybe you can get away with that even because maybe it's growing. Maybe it's attracting new businesses. Maybe people are choosing to move there, and so more revenue will be coming in, but that's not happening either. Chicago is losing companies. And it's losing people. Chicago's population peaked 70 years ago, and it's been contracting since the 1990s. even while other big cities have gone the other direction. And making matters worse, a lot of the people who are leaving are, on average, wealthier than the people who are staying. So it seems to be a situation where if you have the means, you try to get out and move to a different place that's not going to punish you so much for your money. So all of that can still be true, and, maybe the city's learning from its mistakes. But Glock writes that's not happening either. The current mayor, Brandon Johnson, is a progressive Democrat, and he wants even more spending. He's a friend of the public sector unions, which are, in many cases, the source of a lot of these pension problems, because a public sector union can always ask for more benefits, unlike a private sector union, where they're sort of limited by the profitability of the companies. The public sector union is negotiating against the taxpayer and against a government, and the government can't go out of business. So they can always ask for greater benefits. And if there's not a bunch of rich people out there to tax the rich proposals aren't going to solve the problem either. Okay, but don't worry, Chicago got a bunch of money during COVID. The federal government sent Chicago through various different programs about $2 billion during the COVID pandemic. Certainly they had to have used some of that money to make some reforms. But they didn't. And it's much the same story with their efforts at privatization, which should be a good way for them to get their finances back in order, sell off some assets. You don't have to worry about the costs that are associated with those in the future, and you get a cash payment now that you can use to make some budget reforms. But they've tried privatizing some things, and then they squander all the money. Glock gives the example of privatizing the city's parking meters. The city had already spent 85% of the money it made from that within 2 years. They're going to be running into problems pretty soon of just making payroll and problems of sending money to retirees who have benefits due to them. But one of the big problems, and this is what Glock points out, is that this is a threat to public safety. Because a city that can't afford to make its pension payments, that can't afford to pay its employees, also can't afford to pay police, to collect the trash, to do the basic stuff that we expect a government to do. When you have to be cutting back on those kind of services in order to pay retirees who aren't even working for you anymore, that is a really bad place to be. But unfortunately, Chicago is not the only government that's facing that problem. The federal government is too, in a slightly different way. The federal government currently has the majority of its federal budget going to entitlement programs and to interest payments. These are automatic payments that happen every year with no votes from Congress. They follow laws that have already been enacted, and they happen on autopilot. A federal government that is making those kinds of payments and having those kinds of payments eating up a larger and larger portion of its budget isn't going to be able to spend on things like national defense, things like transportation, things like education, things that, for better or worse, the federal government is in large part responsible for financing. This is something that should concern everyone, no matter where you come down on the political spectrum. Personally, I would love to see the federal government do a whole lot less stuff to begin with. But even if you want the federal government to do more stuff, it can't pay for the stuff it's doing right now. And we're running into a situation where, as Margaret Thatcher used to say in the UK, socialism works until you run out of other people's money. This is a problem that Chicago is going to run into very soon. And it's a problem the federal government's going to run into eventually as well. Speaking of Margaret Thatcher, it's interesting to look at comparisons between the United States and the United Kingdom on economics. We're going to look in this segment at just one measure of that, which is GDP per capita. That's gross domestic product per capita, so per person in the country. Gross domestic product is a measure of all of the final goods and services which are produced in one country. That's the final goods and services. So that means, intermediate processes along the way. So paying for inputs, things like that don't count. What counts is the final good or service that is produced. And again, it's not just physical things, it's services, it's intellectual output, things like that as well. And so GDP per capita tries to be a pretty inclusive measure of the economic output in a country, and then it's per person. And so in the United States in 2022, GDP per capita, according to the World Bank, is about $65,000. That means the average, on average per person, there's $65,000 worth of economic output coming from the United States. Now, we think of the United Kingdom as one of our close relatives as a country, so to speak. We speak the same language. We, of course, shared the same history until 1776. We have a very strong diplomatic relationship and work together on lots and lots of international issues. We enjoy British television shows and music, and the Brits enjoy American television shows and music as well. There's a lot in common there. But when you look at GDP per capita, the United States, that's $65,000, and the United Kingdom is only at about $48,000. That's a pretty big difference. Now, by global standards, we're both extremely rich countries. The world's GDP per capita is about $18,000. So we're way above that. We're both way above that. But compared to the United States, they're pretty far behind. What's remarkable about that as well is the gap has been growing over time. Back in 2007, right before the financial crisis, United States GDP per capita was only $56,000, but the UK's was $44,000. So from 2007 to 2022, the United States went from $56,000 to $65,000, an increase of $9,000. But in that exact same time span in the UK, they went from $44,000 to $48,000, so an increase of only $4,000. So the U.S. is running away. It's worth mentioning, too, that these numbers are adjusted for inflation. They're adjusted for cost of living. They're as close as we can get to a real apples-to-apples comparison between the two countries. So this isn't just sort of a accident in the statistics or reflecting a different cost of living in the different countries. It takes that into account when we're making these numbers. But then you look at some of the other countries in Europe that we might think are, roughly the same as the U.S., right? Western Europe, we kind of talk about them as our peers economically. But France is even lower than the UK. GDP per capita in France in 2022, in the UK it was 48,000. In France, it's only 46,000. Italy, 44,000. Spain is 40,000. Again, the U.S. is $65,000. So Spain is $25,000 per person behind the United States. And Spain has basically been stagnant. In 2007, that same year we were talking about before, right before the Great Recession, Spain's GDP per capita was about $40,000. They basically haven't moved since 2007. Again, the U.S. in that time went up by $9,000. Spain's basically flat. You look at some of the countries in Central Europe, for example, like Hungary, they're even further behind. They're only at $35,000 this year. One of the fastest growing economies in Europe has been Poland. Poland is up around 37,000. In a couple of years, they're going to pass Spain. So Poland's doing some good stuff, but they're still, again, way behind the United States. Now, one of the only European countries that is ahead of the United States in GDP per capita is Norway. That's in large part because Norway has very large oil reserves and a relatively low population. So they're having a pretty high numerator in their economic output being divided by a relatively low denominator in their population. But the U.S. has been closing the gap on Norway too. in 2007, Norway was about $8,000 ahead of the United States in GDP per capita. 2022, they were only about $2,000 ahead. So when we're thinking about different countries, and obviously GDP per capita is not the only measurement. There's lots of other things that are very important. This is not to say that it's the only thing that matters. But it is to say that these disparities are pretty big. This is not a case of we're all roughly the same. The US is ahead, and it's pulling ahead at a faster rate than a lot of these countries. And so you might hear the argument from people who maybe support more of a European welfare state. And they'll say, well, sure, the government has higher taxes, but they give you back more and better services and saves money on healthcare costs or any of these other things. And that can be true, but that trade-off works under the assumption that you have roughly the same amount of income to start with, right? If it's only a question of how much of my income I want to give to the government relative to keeping for myself, that's one thing. But when you look at these countries and you see how far behind they are actually just in how much economic output they have per person to begin with, now you're talking about something else. Because if you have the lower taxes in the US and the higher output, man, that is a tough sell to give that up. And these European countries have not seemed to figure out a way to crack the code and have US levels of output along with European levels of social welfare. It's something to consider. It's a trade-off to make, but it's important to start with the actual facts of it. And the facts of it show that if you're looking for economic growth, Europe's probably not a great model. Now it's time for the paper of the episode. But before that, if you've enjoyed this episode, please subscribe and leave us a positive review wherever you get your podcasts. It helps us to know you enjoy the show and makes the show more visible for others to start listening as well. I let Theo pick the paper of the episode. From the American Economic Review in June of 1968 by Mark Pauly, The Economics of Moral Hazard, a Comment. Here's Theo to tell you about it.
So for the paper I'd actually like to highlight a comment that was made by a very distinguished PhD in economics by the name of Mark Pauly way back in 1968. And basically, this comment focused on moral hazard and insurance. And one of the reasons that I find it so fascinating is we had already had a lot of government policy that was steering people towards health insurance. And it was not until 1968 that Mark Pauly really zoomed in on the fact that, there is an optimal level of insurance, but it is not full insurance because, and you've continued to see it today, a lot of people want to focus on coverage and just making sure that people have as broad a coverage as possible and as many people are covered as possible. Yet there are some downsides. And what Pauly pointed out is that once you pay in advance, you have a completely rational incentive to get as much for your money as possible. And that incentive might not lead to overall benefit to the healthcare system. And as we discussed on the podcast, once you do create this moral hazard, ultimately somebody has to come in and step and determine whether the value of the service is appropriate and at what price is it appropriate. When you have the individual making decisions, they get to play a role, which I think is very important. Individuals and their patients and their doctors should be having a role in determining what the value of a service or an item is. But if you push things too far in the direction of either insurance or government provided healthcare, either the insurance company or the government has to step in and play that role.
The Economics of Moral Hazard, a comment by Pauly. Read it. That's all for today. Remember, the economy is complicated and nobody has all the answers, but markets work.